The Nasdaq coming off a massive comeback yesterday. The index making the biggest intraday swing since March of 2020, coming back from being down 3.5% midday, closing up over 3%. Joining us right now to break down tech's big move, Sarah Kunst. She is a managing director at Cleo Capital. Also, Daniel Flax is with us, senior research analyst and managing director at Neuberger Berman. Sarah, I hate to ask you whether we're calling a bottom here on some of the FANG stocks in the Nasdaq, but I'll at least ask the question.
You know, I think that the bottom is starting to get priced in. I think that people see this as a belated President's Day sale and want to shop because a lot of the bad news that we're living in today has been previewed to us for quite a while, right? We've known that the stock market has been slumping. We've known, unfortunately, that there was an impending Russian invasion of Ukraine. Now that that stuff is happening, I think people figure, you know, it's not going to get worse in the short term, so let's go shopping.
And you think that whatever the Fed's going to do is completely baked into the cake? If not overdone.
I don't know if it's completely baked in, but I do think that the cake is in the oven and it is getting close to done.
Daniel, is the cake in the oven? Is it getting burnt?
I think, Andrew, the cake is making progress in the oven. I think what the market's looking at and what we are focused on is the innovation and the growth. And even during this new world of COVID, the recession, clearly the shifting geopolitical dynamics and the invasion of Ukraine, we're seeing a lot of opportunity. Take key secular trends like artificial intelligence, the cloud, mobile, this build out of the digital networks. That's very, very healthy. And so look at a company like NVIDIA, which is continuing to innovate. Their solutions in AI or artificial intelligence are important in areas like drug discovery. Qualcomm, which has very attractive growth prospects in the next generation or 5G networks and the Internet of Things. A company like Google or Alphabet is continuing to invest, to innovate. Core search is healthy. YouTube is strong. A lot of potential in the Google Cloud platform. And I'll round it out with Amazon and e-commerce, which remains probably more important coming out of this period than it was going in. They have a very strong business with Amazon Web Services. A lot to like.
I don't think anybody is dismissing or disagreeing with the idea that these are stable and growing and fabulous companies. I think the question today is, what is the valuation of these companies and what kind of multiple do you put on them? That, I think, is nobody's saying there's a good company or bad company or their best days are behind them or this or that. It's literally, what is the multiple in an environment of rising interest rates?
The environment of rising interest rates, in my view, Andrew, is still relatively benign. And I say that because we're the 10-year at 3% or even 4%. That's still very low historically. We've seen from the recent earnings, the outlooks, the data, and the commentary that the underlying drivers of the business are still healthy. Ultimately, I think the market's going to care about revenue and free cash flow growth. Even were multiples to be a little bit lower, I think the stocks as investments over the next 1 to 2 years, the names that I mentioned, are attractive. And so that, in my view, holds even in the face of rising rates, inflation, and the invasion of Ukraine.